recording the demonstration, and then you're going to be following me around as I work the problem out. Okay, this is your project. Do we all have, does everybody have a team? Yeah. Teams of 3? Yeah. Okay, good. And do you know what stock we're doing? Do you know? Goldman Sachs, excellent. Okay, so Penny's here. She's our reference librarian. Say hi to Penny.
Hello.
Hi. Penny's awesome. If you ever have any problems finding any information or want to get some financial information or find some articles and stuff and you don't want to go through the brain damage of figuring it out yourself, I would use Penny. She's amazing. She'll totally help you out.
Thank you. And I have my business card, so I'll pass these around so if anybody'd like to take one. In case you need any help with this class or other classes, you can get in touch with me anytime. I'm just going to give them to you when you just take one and pass them around, if you want one.
And everybody needs to log into your computers and go up to the USF and go up to the library.
Also, I have drop-in office hours every Tuesday at 11:30, so you can come see me. You don't have to make an appointment. You can just come by and ask me questions, get help with research, etc. So let me know how I can help you.
So what we're doing, Penny, is we're doing Goldman Sachs. We're gonna, this is what we're doing. And I couldn't send this to you over the email. So these are the decks that we produced. Does everybody have one of these? Did I show you one of these?
No.
Okay. I might have enough for everybody. So each team is going to produce one of these. You can take pictures of these, as many as you want. I don't care. And they're going to look exactly like this. Okay? And what I'll do is I'll go through the pitch book. It's called the pitch book and a deck. How many people are marketing majors? How many people are marketing majors? Okay. Entrepreneurship, digital media, finance, accounting, management, no majors, undeclared. You see this? This is called the pitch book. It's called the deck. Okay? These are used in accounting and finance and entrepreneurship. They're used in law. You use these to pitch concepts and ideas, communicate concepts and ideas to clients, boards of directors, investment committees, senior level managers, and other important individuals that need to, or you need to communicate to them on a very highly professional level. Okay. And what we're going to do tonight with Penny's help is we are going to collect the data, and you're going to do it too. You're going to help me collect the data from the sources. And we don't have a S&P Net Advantage Value Line or Morningstar. Is that correct?
That's correct.
Okay. So we're just going to use Mergent. Okay. And we'll need to get the industry ratio. We're going to get the industry ratios too. And I'm going to ask for, as you walk us through, I'm going to start asking all of you as you follow along to start giving me data, okay, so that we can pump the data into the model to be able to do the valuation on Goldman Sachs. Okay? I'll let you do like a quick intro, and then what I'll do is I may interrupt you at some point and say, okay, I need PE multiples for JP Morgan, Bank of America, Wells Fargo, Citi, and Goldman Sachs. I need earnings per share dating back to 2001 for Goldman Sachs. I need the long-term debt and the long-term equity for Goldman Sachs, stuff like that.
Okay.
Okay?
Sure.
Okay.
Hey everyone, how are you?
Good.
Teacher asked me to come tonight just to show you a couple of things. One is downloading financials for public companies, and also we're going to look a little bit at industry ratios, and I have a couple of other ideas too. I know that your teacher had mentioned something about ranking, top 5 banks, things like that, and you may be figuring that out using computations. But there's also a database called Statista that some of you might be familiar with, where you can actually find companies ranked within an industry based on particular criteria, right?
We're going to use 2017 assets.
Okay. I don't know what that means.
It's, that's what we're going to be doing the rankings, and we're going to be doing them by the top five banks based on assets.
Okay. Okay. So if you're clicking along with me, you'll need to go to the library homepage, And I'm kind of low sitting down here, but if you have questions, like, raise your hands really vigorously so I can see you, okay? All right, library homepage. So the first database I'm gonna go to is called Mergent. So it starts with an M, Mergent, and the way to get to the database is if you go to search, that's the upper left-hand corner, and then databases. And you might want to look at either side of you, make sure your neighbors are in the same place too, right? We can all help each other get to the database together. And then the next thing is databases A to Z. And then M for Mergent. So Mergent is a database that has a lot of really great sort of overviews and financial information and going back a number of years and ratios and things like that on all kinds of publicly traded companies. Okay, so this is a great one if you, couple reasons why you might use Mergent, if you want to just kind of do some company analysis, or if you want to just download data for a variety of purposes. You can download everything into Excel and then do whatever computations that you want to do with it. So it's a great database to know about for that kind of information. So I'm going to scroll down and go to Mergent. Probably we're going to be prompted to log in. So just my USF.
You can just sign in.
Okay.
Because it'll reset.
It'll do the same thing, yeah. It'll behave the same way. Okay, so once we get in there, how's everybody doing? Everybody finding Mergent okay?
Mm-hmm. Yes.
Look to the left. Is your neighbor on the left finding it? Oh, I look to the right. Look to the right. Your neighbor finding it? They need help? Look to the left. Does your neighbor on the left need help? Everybody cool?
You need to be
All right.
focused on this, please. You need to be focused on this. Because that's why we got the computer lab, especially for this project. Okay? So please. Okay. I didn't mean to interrupt you, but
No, that's
people are
fine.
working
That's
on
okay.
it.
This is a flowing thing, so
Okay.
please interrupt as much as
Oh, thanks.
Yeah, that's fine. Yeah. I don't need to be like,
Thank you.
yeah. All right, so the quickest way to search is just kind of putting in your company name. So we're doing Goldman Sachs, right?
And the ticker's GS.
Okay. GS. All right, cool. So we can just select Goldman Sachs Group Incorporated, right? GS.
Yeah, and what you want to do is you want to go into Mergent. Sorry, I didn't mean to interrupt you.
That's okay.
Go into this, go into that prior tab and open up Goldman Sachs, BAC, which is Bank of America, Wells Fargo, which is WF, Citi, and Goldman Sachs. So pull up all 5 stocks in an individual web page so that we can dig into those and start pulling out the data. You're not going to be like digging around looking for data. Everything is in Mergent. So I'm going to need you to be 42 analysts digging for the data so that we can get through the valuation, unless you want to do the valuation on your own.
So are you saying everyone should open 5 tabs so they
Yes.
have Mergent open 5?
Yep.
Okay.
Yep, because they're going to be digging to get the data, so I can put the data in the model so that we can run through the model, which is basically the solution to the pitch books that you're going to be working on, that you're going to come back week
Do I
after
need to open
next.
5
We're not going to have a
tabs?
class
So I
on
don't need to
Tuesday.
open 5 tabs, right? I'm not going to open. Do you want me to open 5 tabs also?
Let's just see how things go.
Okay.
I'm telling them to do the 5 tabs.
Okay, cool. Because I totally can.
Is there Bank of America?
Right there. Right there, the tickers are right there. So JP Morgan, BAC's Bank of America, WF is Wells Fargo. I don't know what Citi is. What's Citi? What's the ticker for Citi?
C.
C?
Yeah.
So, and then GS is Goldman Sachs. I just want them to pull it up. You just show us where the data is, and then they'll be able to go get it.
Okay, so once you have the tab, so basically all of the company profiles look the same. They're set up exactly the same way. So no matter which company you look at, it'll all be in the same place. So the simplest way to get to the company financials is once you're on the main search page here. Did everybody see how to actually get to the company search pages? To the main page? Okay. So once you get here, the fastest way to get the financials is just to click on this company financials tab. And then, so there's a couple of things you can do here. You can,
Oh wait, look, the total assets, that's what I want. Is it 9 point, oops. GS is what, 0.92 billion? Billion? No, 920 billion. 916 billion, is that right? 916 billion. And could you do me a favor and go up to these other stocks and write down the total assets for 2017, and I'll ask you for those later. So if you could do that for me, I would appreciate it. Thank you.
Is it in millions or billions?
JP Morgan is like 2.something trillion, so Goldman Sachs is 916 billion. Go ahead, Penny. Sorry.
oh, that's okay. So, so basically we have the financials here, and you can kind of pick out which things you're interested in. Sometimes when I'm not sure how to find a certain thing, I will just use the, you know, the Control F.
Oh, you know what we need? We need to find the long-term debt and the owner's equity so we can calculate the weights to calculate the weighted average cost of capital. Maybe you guys can find it. What's the long-term debt?
So
and the
long-term
owner's
debt.
equity? Yeah, I need unsecured long-term debt, and I need the owner's equity.
Now, is this in the, right now we just have the balance sheet, so should we do
Yeah, it's in
all
the balance
sections?
sheet.
Okay.
It's in the we just need the annual 2017 long-term unsecured debt and the owner's equity. Are you guys looking up to date? Yes. We're not doing Wells Fargo, we're doing Goldman Sachs. And that is just an example of what the deck will look like. I'm not going to give you the deck of Goldman Sachs. That'd be crazy, right? Right? Because then you'd just be copying it. So can you look up the unsecured long-term debt for Goldman Sachs and the owner's equity?
So if you're looking for particular things in the statement, if you can do that Control F, or if it's a Mac, what is it? Command F.
Yeah, I was in
What is it? Is that owner's equity or long-term?
long-term borrowing.
Yeah, it's how much?
Yeah.
217
217,000
217 billion.
billion 687.
Oh, we'll just round up. So 218 billion? Okay, got it. Now, test question. Would the long-term debt be more or less than the owner's equity? Do you think Goldman Sachs levers up the firm to juice the ROE? Can you deduct the interest on the bonds? Can you deduct the interest payments on the bonds? Coupon interest? So are you going to use more or less debt?
More debt.
More debt. So what's the owner's equity?
Less than
Yeah,
that.
so what is it?
Where did
82,243.
82 billion?
Yeah.
Is that correct? Can you guys
Yeah.
verify that for me? Okay, perfect. All right, Penny, go ahead. Thank you.
Okay, so I mean, basically, once you get to merchant, I mean, these are the financials. I mean, this is the page of financials. You can look at different sections of the financials, or look at all sections. And then as you're looking for particular items, if you do Control F on a PC or Command F on a Mac, you can search for, like, when we just had to do long-term, I just put long-term in, and then it showed me every place that term appeared. So that kind of helps you quickly look through, instead of kind of going down a list and scanning. It kind of helps you quickly skim through the financial and find the exact thing you're looking for.
Didn't I see earnings per share up there at the top?
You may have.
At the summary section? Didn't I see
Oh,
it?
you mean in the first section that we
Yeah,
looked at?
right here, this basic earnings per share.
Oh, yeah.
1421.
Yeah.
Is that 2018?
Let's see.
I think it might be. We'll check it when we go dig out the earnings per share for the stock going back to 2001. You don't know.
So this will go back to, this will go back to up to 15 years. Let's see if it goes back to 2001. Oh, 5 years, whoops. Okay.
I don't need the balance sheet going back that far, but I do need the earnings per share. Are we gonna use earnings per share as the cash flow metric to value Goldman Sachs? Or are we gonna use EBITDA per share? Are we using earnings per share or EBITDA per share? Earnings per share, because it's it's almost $1 trillion firm. It's been around, how many years has Goldman been around? Like 100 and something. So is that a mature firm? Yeah, so you're gonna use earnings per share. All right. Thanks, Penny. Sorry, didn't mean to.
Oh, no, that's okay. So essentially though, I mean, so this is how you find the data. We have up to 5 years worth of the data. You can download it into Excel, and when you make changes, you can, every time you make a change, just refresh and then it will display the data. So that's basically how to use Mergent's data.
How do you get the earnings per share? What we're gonna do is we're gonna go back in time, put in earnings per share, calculate the percentage change per year, identify the time periods in which we were in a recession, recovery, growth, peak, and decline. And then, since we're not in a recession today and not in the decline phase, we'll go back and look at the growth rates in the recovery, growth, peak phases of the last 2 cycles and use those as a guide for us to be able to project out over the next 5 years. So we need the...
Okay, well, I'm not seeing that I'm not seeing that
I think
there.
that's in, might be standardized.
Oh,
I think it might be up here.
oh.
And I think if we go down, I think they give you basic and diluted earnings per share, I believe.
It says it on the
Here it
top.
is.
Here we go.
It does say.
Go down a little bit more. Net diluted, average shares, EPS, basic, net basic, continuing basic. They're the same, it doesn't matter. So we got that. So what year is that? 2017?
Yeah.
It's 9.12. How much, what was it for 2016? Can you guys start just yelling it out?
16.5.
What was it for 2016?
16.5.
16.5, what was it for 15?
12.3. I don't know if I'm looking at the right number though.
Okay, don't give me the wrong numbers.
But
Is it this one right here? Either net basic or continuing basic?
it's net earnings per share. So it says.
Yeah, we want earnings per share.
Yeah, then I think I'm.
All right, so can you give me those?
Is it what?
Where's the tab?
Yeah, I think it's
We don't want retained earnings, we want
Is it
earnings per
under-
share.
income
Well, I'm
statement.
trying to figure out where that is, because mine is.
Go back to the
Okay, did you go up to
company
standard?
financials.
You might wanna go back.
Oh, you have to switch the display to standardized?
Company financial standardized.
Yeah,
It's under
I think
income
that's-
statement
Yeah, it should be under income statement.
Oh,
instead of balance sheet.
It's not the balance sheet.
And then if you do that
That's
control
a
F,
financial accounting test question. Which you all got A's in. Okay, so can we go back down there? Can you show me the, that basic and that, this,
I think so.
can we go back to 2001 on an annual basis?
no, we can't in Mergent, actually,
Can you go back to all available years?
yeah.
And then refresh?
So we're limited to 5 years. I'd have to think about if we have that somewhere else. I can write it down and let you know.
Yeah, we need to be able to go back at least a couple cycles. Can you see if you can find it on NASDAQ.com? Can you maybe Google, Goldman Sachs earnings per share annual, and see if you can find me a historical time series of Goldman Sachs EPS. And while you're doing that, Penny, why don't you show us where the return on equity is and the return on assets, so that you guys can start going up and pulling off the return on equity and return on assets for the top 5 banks.
Okay, so, I don't know where that is,
I
so
think it's
I would
under,
probably, do a Control F and search it.
I think it might be under analysis. Oh, look, there's the basic calculation too. Can we get it to go back? Oh no, that's not the ratio. Are we in ratio analysis?
Would you like it be? We could be.
Yeah, I'm looking for the ROE, ROA. Oh, here it is.
Oh, I got it.
Got it, perfect. Okay, so what is why don't you read that off to me, and then we'll go back and you guys start looking up the other tickers and give me the information for return on equity and return on assets for the top 5 banks. So what did you have for Goldman Sachs for ROE?
For 2016 or 2017?
2017.
2017, the ROE is 5.07,
5.07.
and then the ROA is 0.48.
0.48, great, okay. So can you give me the rest of it?
Yeah, for JP Morgan,
Okay, hold on a second. I know I only have you for a half hour, so I think we got it.
Okay, I mean, if you, what would I do if we were would I just be driving the computer while?
Yeah, what we're doing right now, since we know where to get the data, I'm gonna make them collect the data
Okay.
for me. But I do need, and then we're gonna try to see if we can get the EPS going back to 2000. Because we need to project out what the earnings per share is for the next 5 years. And usually what we can do is if we know what the earnings per share growth rates were in the most recent period in the growth peak phase of the business cycle, we know what the probable growth rates could be over the next 5 years. So it gives us kind of a guide. But if I don't have the history for Emergent, then we'll see if we can go to NASDAQ or someplace else to grab the data.
Okay. I mean, I'm happy to stay longer if there's something I can be doing.
Yeah, sure.
I mean,
Okay, then let's go into these other tickers right here. And let's pull off the return on equity and return on assets. Let's get the total assets for the individual banks, and then you can yell it out, or you guys yell out the data, and then I'll put it up. I want them to learn how to dig into the databases to get the data. Okay, so give me the numbers. What's the return on equity and return on assets for JP Morgan?
the return on equity is 9.59,
Okay,
and the return on assets is 0.97.
0.97. Is that what everybody's getting?
Yeah.
Everybody getting it? Everybody following? Okay, you guys in the back, do you know what we're doing? Okay. What about Bank of America? What about ROE, ROA?
ROE is 6.83
6.83.
and ROA is 0.82.
0.82. Can you give me Wells Fargo?
It's ROA is 1.8
1.8.
and then ROE is 13.
No, you got it backwards. ROA can't be 13.
What?
ROE is 10.9.
That sounds better. 10.9. And what's ROA for Wells Fargo?
1.14.
What's going to happen is you're going to go into these databases and you're going to start pulling out data, and you're going to put the data into your spreadsheets and stuff like that without even checking it. Okay? Without even checking it. You'll just put it in, and it's got to be reasonable. What's going to be higher, ROE or ROA?
ROE.
ROE, okay. So you can check it that way. What is ROE and ROA for Citi?
Negative 3.19.
And what about for ROA?
negative 0.37.
Got it. And then what is the total assets for 2017 for JP Morgan?
Was there anything else you wanted me to show the group?
No, just, that was.
Okay.
what we needed.
All right.
But thank you very much for
Sure,
showing.
sure,
And
no
thank
problem.
Penny.
Thanks, Penny.
Penny's awesome.
Huh?
He said, you're awesome.
Oh, thanks.
You're a huge
Did everybody
resource.
did everybody get a business card from Wonder One? Were there any left over? Or did everybody get one? Okay. Anyway, have a good night. Let me
Thanks,
know if you
Penny.
need anything. I hope that helped. And
Thank you.
I'll
It did.
also, since I know you need some more historical stuff, I'll take a look at it, see if I can find some sources
Yeah,
and I
that-
can send some
I
links.
thought we had it in there.
I know, me too.
Yeah, it might be
Okay.
buried somewhere. I'll
Yeah.
make them find it.
Okay, okay, but I can send you some ideas too.
Okay, great, thank you.
care.
JP Morgan, total assets, 2007.
2 million.
No, no, no,
Or
It's 2
2
trillion.
billion.
2
2
trillion,
trillion.
2.1 trillion,
5 roughly.
0.5 trillion. Right, and this is gonna be 0.92, Trillion.
It's in the millions. 3 million.
this is the world in which we work in, people. Hundreds of millions, billions, trillions. If you don't want to play in this game, be a psych major or something. In business, we're doing millions and billions and trillions, okay? Huge responsibility, okay? What's the total assets for 2017 for Bank of America? That's okay, I was a clinical psychologist major. Bank of America,
2.2 trillion.
2.2 trillion, awesome. And then what about Wells Fargo? How big is Wells Fargo?
Big.
Yeah, it's big too.
Whoa.
You guys are all in margin,
I don't know.
you know where to go to get it, balance sheet.
Are you looking for the Wells Fargo
Looking for
financial?
Wells Fargo 2017 total assets.
I don't even know how to say that.
2 billion thousand?
So it's 2 trillion.
Oh, 2 trillion.
Oh, I see.
Okay, and Citigroup. Yeah, these are just really small companies.
Huh?
Really small companies. That's why they hire from, you know, the top schools.
It's 1.8.
1.8 trillion,
Yeah.
got it. Actually, Wells Fargo and B of A hires a lot from USA, especially Wells Fargo. Can you add that up and give me the total? And then can you add it up, give me the total, and then divide them back and give me the market share? Give me the share, the percent. You're gonna need your calculators, people. You gotta pull out your calculators. Sorry, this is a finance class. You might need your calculator. Or you can put it in a spreadsheet. So can you add that up for me, please? This will be a really super long class, you know, drag on for a really long time. Unless you guys like get engaged and start feeding me the data.
The total's 9 trillion.
9?
Well, 9.4 trillion.
Okay, 9.4 trillion, thank you. This is the application, this is what we've been fighting for to get here for the whole semester, okay? So what's 2.5 trillion divided by 9.4 trillion? Give me the share.
0.27.
27%,
Yeah.
okay? What's 2.2 divided by 9.4?
23%.
Okay, the faster you calculate, the faster you give me the information, the faster we'll get through this. What's 2 trillion divided by 9.4?
21%.
What's 1.8 divided by 9.4? What?
20%.
20, thank you. Sorry. And then what's 0.92 divided by 9.4?
Point 1.
It's like 10?
Yeah.
Does that add up to 100?
No.
Let's take it from,
89%.
what is it? What is it? 100? Okay, got it. So now could you do me a favor? This is going to be hard. I'm gonna need a color pen.
Wait,
Now
what is
we're,
it? What is this? Market what? How you just calculate?
market share.
Oh,
And it's also called the weight. Because what most students will do is I'll ask them to calculate a peer group, return on equity for the peer group. And what they'll do is they'll just take the average of the ROE and give it to me as the peer group because it's easy, right? Is it more accurate to take the average or the weighted average?
Weighted average.
Weighted average, right? You're gonna be doing a lot of weighted averages. All right, so here's the hard part, all right? Here's the hard part. What you need to do is take 0.26 times 9.59 and give it to me. So it's 9.59 times 0.26. I'm getting the share. So it's 9.59 times 0.26.
0.2.
What is it?
I think I
9.5.
2.5.
Got it. And what's 6.83 times 0.23?
1.6.
What is it? 0.6?
1.6.
1.6. Okay. And then what's 10.9 times 0.21?
2.3.
2.3. What's 0.2 times negative 3.19? 0.2 times negative 3.19?
Negative 0.6.
Negative 0.6. Is that correct?
Yes.
Got it. And then what's 5.07 times 0.1?
0.5.
What is it?
0.5.
0.5?
0.5.
Is that correct? Okay. So it's 2.5 plus 1.6 plus 2.3 minus 0.6 plus 0.5. What does that give you?
Was the first one's 2.5?
That's 2.5.
Is that 2.6.3?
6.3. So my peer group return on equity is 6.3. That's going to go into your peer group slide, and I'll go through this presentation in a minute. In the presentation, you're going to have two slides of financial conditions of financial ratios, in which you're going to be conducting financial ratio analysis. And right there, in this case, you're going to be doing Goldman Sachs, but we did JP Morgan last semester. There's JP Morgan right there, ROE. You're going to use Goldman Sachs, okay? Goldman Sachs is going to be the target. Then it's going to be JP Morgan because that's the direct competitor. And then the peer group ratio for the ROE, you're going to use 6.3. And if it was done right, it's probably pretty close. It was 8.7 at this time. And then the industry, she didn't show us where the industry ratios were. So we'll have to try to find those. Those are really hard to find. So I'll walk you through how to plug those numbers. Usually I make them slightly less than the peer group, okay, for theoretical purposes. So let's calculate the weighted average peer group return on assets. Okay. So what's 0.26 times 0.97? .26 times 0.97 gives us, what is it?
0.25.
0.25. What's 0.82 times 0.23?
1.
0.19. What's 0.21 times 1.14?
0.2.
Is everybody getting the same numbers?
Yes.
I get really scared when one person says the answers, because I have 42 analysts in this room and I got one person that's telling me the numbers. That scares me. Okay. I need validation verification, please. What is 0.2 times negative 0.37?
0.07.
0.07. What's
Negative.
point? Negative. What's 0.1 times 0.48? Is it 0.0? 0.048, isn't it?
Yep.
Yep. can you add those up and give me the peer group weighted average return on assets, please? Can you hear me back there? Can you add these up?
What's the first
We're
one?
gonna be back there in a minute, so I'll be able to, you guys will be engaged over there too. So can you add those up? What'd you get?
Yeah.
0.25 plus 0.19 plus 0.2 minus 0.07 plus 0.048.
0.618?
Yeah.
0.62, 0.62. So your peer group return on assets is 0.62. You're going to be using a lot of weighted averages. This is the correct way to do it. You're going to have to do it for the other financial ratios. What I would do is plug this in, program this into Excel, and then just copy and paste it, and then just change the ratios, and I'll just calculate it for you. It's really easy when you do it in Excel. It takes a little bit longer if you do it by hand. Some students like to do it by hand. I don't recommend doing it by hand, because you're probably going to make a mistake. Okay? All right. So that's the, do I need to go into here? No? Did you guys find the earnings per share for Goldman Sachs going back to 2001? I found a flaw in the system. They don't go back, or it's probably in there somewhere. You just got to dig around and find it. So we're going to have to come back to do that. Let's see if we can find the history. It really is tough to do the economic analysis, the financial economic analysis using business cycle theory and business cycle analysis to get the projected earnings per share without using a pro forma statement and spending the whole semester on financial statement analysis to get the EPS. We don't have time to do that. Okay. So maybe you guys, as we're working through this stuff, maybe you can dig around, see if you can find me some EPS going back in time, so we can do it the right way. Let's go over here, because I need the valuation models. Wait a minute, maybe before we go this way, let's stay this way. Why don't you give me the PE ratios? Since you already have all 5 of the stock websites up. Why don't you find me the price earnings multiples for 2017 and 18? And maybe you can find me some 2019 too. So on the website, there should be a PE multiple in the financial ratios. I'm going to turn this thing back on. You can also go up to NASDAQ.com. I think they have some PE multiples, and up in the top of the dashboard, and I think Yahoo Finance might give you the PE multiples too. Do we want to be under balance sheet, or do we want to be under income statement? Check out equity pricing too, maybe.
It has like a PE ratio on the with the light blue.
It does, what's the PE for 2018? In that blue section, you said there's a
Yeah,
multiple?
well, it says the ratio.
It says PE multiple?
Oh,
PE?
no.
Does it say PE?
Yeah, it's PE ratio.
Okay, perfect, so give me the numbers.
It's it just it only gives me one.
That's okay.
13.46.
Okay, and what is it for JP
Oh,
Morgan?
sorry, that was for JP Morgan. I want a different one. Sorry about that. Goldman Sachs is
can you guys check these numbers for me too? Can you pull up the bank? Excuse me, ladies, are you, ladies, can you help me find the PE multiples for the top 5 banks, please? Yes.
For city, 2017 is 12.7.
Oh, great. Excellent. Do you have 2008 too?
10.3
Great.
or 10.1.
Awesome. And then can you give me Wells Fargo and
8.3.
where are you finding that?
NASDAQ.com.
Okay, perfect. And then give me Wells Fargo 2017 and 2018.
For city, 2019 it's 8.93.
Okay. Okay, but that's just an estimate by NASDAQ. We'll go back and see if we want to keep their multiples or not. Again, I like using historical audited numbers. I don't like to use projected estimates from other sources. I think we can do a better job. So what did you get for Wells Fargo?
12.1.
12.1?
Yeah.
And that's for 2017? We're on NASDAQ.com. Are you finding the info?
Yeah, I'm on NASDAQ, but.
Are you just typing in the ticker and it gives you the EPS? Or do you want to come up here and show us? Okay, just read me the numbers then.
For Bank of America, it's 15.16.
Okay, for 17?
Yeah.
Okay, what is it?
15.16.
Okay, just round up.
Okay.
And then what do you get for 2018?
11.
And what do you get for,
9.7.
well, how much?
9.7.
And then was this Wells Fargo, was that for 2017?
18.
Okay. Got it. And then what was 2017? And give me 2019 estimate. You all should be on NASDAQ.com, putting in and trying to dig around and find the earnings per share.
It
Yes,
doesn't have data on Wells Fargo,
Yeah.
for 2017.
just in general.
It's got 2020 though.
Yeah, you can probably find it from another source.
From macro trends. Is that credible?
We'll take it.
For 17.
Can I go back to 2017 and take the 2017 earnings per share and divide it up into the 2017 average price and get a price earnings multiple?
Yeah.
Can I calculate it myself? Okay, do I need to rely on other sources to find it? Can I calculate it myself? Yeah. Okay. So what's Wells Fargo's earnings per share for 2017? You can get the earnings per share off Mergent, and you can go to Yahoo Finance to get the stock price for 2017. Divide the stock price by the 2017 earnings per share, and you get the PE multiple. So once you do that.
Are you looking for PE ratio or EPS?
PE ratio.
That's 14.6.
For what year?
2017.
For Wells Fargo?
Yeah.
14 what?
0.6.
Got it. Does it give you a 2019?
No.
Okay.
I could try.
What about JP Morgan 2017? You all should be on the website. I see people writing stuff down, not working the computers looking for the data. This is the exercise. It's not writing down, copying down the data that we're giving you, but actually trying to find the data, okay? It's a difference. You're gonna be walking into these business units, you're gonna be walking into these meetings, and they're gonna expect you to find the data right there. You're not gonna wait around, there's no professor there that's gonna be basically telling you the answers. You gotta find the answers. Okay?
15.9.
What is it?
15.9.
Thank you.
For JP Morgan, the ticker is JPM.
JPF?
M.
JPM, thank you. Thank you.
2019 was 10.8.
For JP,
Yeah.
10 point what?
8.
Are you guys all checking these numbers, making sure they're correct? Okay. Did we ever find a Wells Fargo 2019? Can we forecast it? No, because we haven't come up with the earnings per share for 2019 yet. What about Goldman Sachs? The 2017 PE ratio. Can I go to merge it and get the 2017 earnings per share for Goldman Sachs? Can I go to the, can I find the Goldman Sachs average price in 2017 and calculate the price to earnings multiple ratio? Can I do that? No? Yes? I can. So can you do that for me, please? Pretty please, with sugar on top. Can you find me a 2017 PE multiple? Can you
For
calculate one for me?
Goldman Sachs.
Yep.
For Wells Fargo, it says 10.2,
For what?
2019.
Thank you. So I need Goldman Sachs now. We'll be in pretty good shape. We're going to test, we're going to verify the numbers. Okay? I don't like to just take the numbers. I'm pretty comfortable with the 2017, but we're going to test the 18 and the 19, and then we'll, if we have to modify them, we'll modify them. Anybody coming up with any Goldman's? I got 42 analysts. I have 42 analysts in this room. 42 brains working hard to find me the PE ratio of Goldman Sachs for 2017, 18, 19. Everybody should be on their computers. Everybody should be searching for the PE multiples. Goldman Sachs for 2017, 18, and 19.
2018 says 8.14.
8.1.
I think this might be,
Everybody else is above 10. How could Goldman Sachs be less than that? The company uses leverage. It's one of the most profitable banks in the peer group.
2017 is 29.4.
Is that true?
I don't know, I'm confused.
Maybe.
That seems really high.
Yeah.
It does, but it just, there's like a big peak in the graph.
Were you
The end of the year, December
well, don't use
31st,
the end of the year, use a midpoint during the year.
11.4.
For 2017?
Yeah.
And what did you get for 2018?
Middle of the year again, 17.7.
Let's test it. What's the current stock price of Goldman Sachs?
205.
205? And where was it last year? Yeah. This is 205,
240.
240, and 2017. Do you have another? Or was it in 2016?
2016, it was like 13.
What?
Oh, never mind. No, wrong.
It's 210.
140.
210 in 2016?
Yeah.
It's
What was the high?
I'm getting
How
the
high did it
high.
get?
The highest was
Yeah, how high did it-
234.
how much?
Wait,
Got 270.
270? So we got, it's currently 205, 2017 it was around 240, and the high was 270. Okay, and it's currently at what, 205?
Yeah.
So we got the price, we got an earnings per share estimate over here. So what's 205 divided by 14.21?
14.42.
14.4. 11.4, 14.4. I would double check that. Because I would think that the PE multiples would be higher in 2017 than 18. And I would think that they would be going down. Is that right? 205 divided by 14.21?
Yep.
So we got, you gotta check that. We'll do some analysis around this, but if you can get me,
well,
go ahead.
it was 11.4 in June 30th of 2017, but that was not the highest for the year.
Yeah, give me like an average for the year.
I would
Give me
say
like a midpoint, just rank it on a quarterly basis or something, and then take the midpoint, take the median. Or just eyeball.
it's spiked at the very end to 29.
Yeah, that's an
Yeah.
outlier. That
Yeah.
doesn't make sense.
I would say 12.2.
we got some, we have some numbers in there. Okay. So at least we can work with it. So we got the financial ratios, we got them pretty much enough for the multiple approach. Unfortunately, I'm stuck in the water here. I got a bottleneck in my data. I still think Mergent has the historical data, although it did say that we were limited to 5 years, which is unfortunate, right? Because how do you conduct cycle analysis and financial analysis with only 5 years of data? It's hard. Can you see if you can mine the internet and see if you can find me some earnings per share, maybe off of NASDAQ.com? Going back in time, I heard.
Could you find it on the annual report?
No, not the annual report. No, unless you want to go back each annual year, which would take you a long time to do it.
They have it on the on Mergent. That's what I was just wondering.
They have what?
They have an annual report from 1998 to.
Yeah, but they don't have it going back to 2001.
Yeah, it goes to 1998 on there.
Oh, so can you go in there and
Yeah, I can see.
is there? See if I mean, that's going to be tedious, is
Yeah,
to go
it's-
into each individual annual report to pull out one
But-
data point.
If you go on reports, it gives it to you year by year, and it says annual report.
Are you on
On
Goldman Sachs or Mergent?
Mergent for
Okay,
Goldman
let's go
Sachs.
Yeah.
Yeah.
So you said what? If you go to reports?
If you go to reports,
and then where do you
under,
go from there?
and then it's all there,
Yeah.
right there. You'll see it. And then year by year, it gives you annual reports.
Yeah, but I'm saying it doesn't give you a time series of the earnings per share.
Oh.
You're telling me I have to go into the annual reports to pull out one data point,
Yeah.
right? So there's got to be, there's got, has anybody gone up to NASDAQ.com?
Yeah.
Okay. Was there any earnings per share, historical earnings per share for Goldman Sachs? Yeah.
Goes to 2017.
Goes back what?
2017.
So it doesn't go back far enough.
Not far enough.
Yeah.
Oh, I found it on NASDAQ.
Did you?
Yeah, 2009, average EPS was 22.13.
Yeah, does it go back to 2001?
No, it only goes back to 2009.
Okay, I'll take that and then we'll go back and see if we can dig around and find some more. So give me 2009.
Average EPS was 22.13.
22.13, what'd you get for 2010?
13.18 for
What'd you get for
2010.
2011?
2011 is 4.51.
And what'd you get for 2012?
14.13.
And where'd you get for 13?
Hold on. 15.46.
And what'd you get for 2014?
17.07.
And what'd you get for 2015?
12.14.
Okay, close. And what'd you get for 16?
16.29.
Okay, perfect, so they're close.
Okay.
They're close enough.
Okay.
Anybody else see if they can dig out? We're getting close. A little bit more history here.
I just searched EPS for Goldman Sachs history, and then it was this chart on NASDAQ.
We're gonna burn through this pretty quickly if we can get those numbers. What about Y charts? What about Yahoo Finance?
Y charts only shows.
We got half the data.
It's. I think they have it all, but.
Yeah, but you gotta pay for it.
Yeah, you gotta pay for it.
think I might have found it. Okay, I think I got it. Okay, so here's the deal. I'm gonna need somebody to come up and help me. So this is what I did. So I went up to company financials. I went to income statement. I went to all available years. I refreshed it. Income statement, all available years. Refreshed it. And I got down here, earnings per share net basic, starting in 2017 was 9.12, and I'm able to go back all the way to probably even further than that, because I had to poach into my St. Mary's College library across the bay where I teach so I can get the historical data, okay? Because we don't have access to it. So can somebody come up here and then read off the numbers so I can finish the time series? I promise I won't. Okay, and this is what you're doing right here. This one right here. Starting from here and then going back. Yep. So just verify these numbers. 9.12.
Yep.
16.5.
Mm-hmm.
12.3.
Do you want like the second decimal point?
No.
Okay. Yeah.
17.1.
17.5.
Okay, I'll just do that. Yeah, just round it. 17.5, 15.46.
I got 16.3.
60 for 2013.
Yes.
Okay, and what about 2012?
14.6.
Okay. And what about 2011?
4.7.
And what do I get for 2010?
14.2.
And what do I get for 2009?
23.7.
And what do I get for 2008?
Negative 2.15.
What about 2007?
4.7.
2006?
26.3.
2005?
20.9.
2004?
11.7.
2003?
9.3.
2002?
6.2.
What is it?
6.2.
Got it. In 2001?
4.3.
Can you do me a favor and calculate the, do they give you 2,000? We don't need it. Can you do me a favor? Can you calculate the percentage change between each of those years and give it to me, please? So what's 6.2 minus 4.3 divided by 4.3? What's 9.3 minus 6.2 divided by 6.2? Can you give me the percentages for me, please? Okay. Is everybody following along? Do you know what we're doing? Okay. This is what we've been working for the whole semester. Okay, is to apply all of the tools that you want. Okay, so can you break out your calculator and give me the percentage changes for the earnings per share for each of the individual years, please? So what's this? Can you give me the percentage change and then start giving them to me? As fast as you can. What is this? Is that 44? Is it? Yes? Okay, what about this?
50.
I need you all to be doing these calculations, guys.
25.
What is it?
26.
Got it. And what's this? What is it? And what's this? What is it?
26.
And what's this?
Whoa.
It's gotta be negative something. Negative something big. What is it?
Negative 81.
Thank you. Got the shareholders are happy about that. What about this? Negative minus a negative divided by a negative. It's kind of mess with your head a little bit. So what do we get? Negative what?
147.
Is that possible? Is that possible?
I got 313.
Something crazy? Okay, it doesn't matter. That's gonna be a crazy one too, right? What was going on in here?
The recession.
Yep.
Economy crash.
The EPS is all over the place, right? We got a problem in here. Right? So what's this? That's gonna be what, like 1,000 something crazy like that? Can you do these mathematical calculations? Can you do the math? What is it?
Negative 1,001.
No, it can't be. It's going from negative 2.2 to 23.7. Trina, come on. Do the math. Unless I'm boring you.
Negative 900. Oh wait.
How can be negative? You want to go from a negative to a positive?
977.
Is that possible?
You got 23.
I guess so.
The EPS is extremely volatile during this time period. Is it, would earnings per share been a good numerator, a good cash flow metric to use during the recession? What about this, from 23.7 to 14.2? Why don't you give me that one?
Negative 40.
Negative 40. What about from 14.2 to 4.7? What's that? This is the reality in which you business majors are basically operating in. Business is not easy. Okay.
Negative 66. Or negative 67. if you wanna.
What's this? From 4.7 to 14.1. What do you get?
200.
What about 14.1 to 16.3? What do you get?
19.
13.
What about 16.3 to 17.5?
7.
What's 17.5 to 12.3?
Negative 30.
Negative 13,
30.
30.
Yeah.
What about 12.3 to 16.5?
34.
34. What about 16.5 to 9.12?
Negative 45.
What about 9.12 to 14.21?
56.
Okay, so which one of these can we use? So we were in a recession there. What were we doing in 2001? Were we in a recession back then too? You remember?
Yeah, we were.
Yeah, we
2001.
were. So we were in a recession back in here too, right? And then this was what? just like your growth peak phase right here. Business cycle. Right, then we went into another recession, right? Through 2010 and 11, and then came out of it probably around 2013, 14. And it looks like Goldman took some charge-offs on their earnings per share, took a hit right there, which gave us some volatility in here. I almost can't even use any of this stuff. Agree. A lot of these are totally abnormal, except for maybe these two right here. Can I use negatives? Are we in a recession? No. So can we use the negatives? Do you think Goldman Sachs earnings per share is going to go down? No, no, no. Do you think it's going to go up, what was it, you think it's going to go up 977%?
No.
Do you think it's going to go up 56%? Do you think it's going to go up 34%? Maybe not, maybe. So that's at least, so what about 26%?
Maybe.
Yeah. Maybe. What about 79%?
No.
What about 26%?
Maybe.
Maybe. What about 50%?
No.
What about 44%?
No.
No. What about 200%?
No.
No. What do we got? We got 26%, 15, 7, something like that. We got what? 25%. 15%. We got 7%.
Why 70%?
Huh?
Why 70%? 2050.
Which one?
2050.
It's 30%. Negative 30. Yeah. So the range, the probabilistic ranges that seem to be reasonable, is somewhere between 25 and 7% with a midpoint of 15%. Okay. So based on what you know, what do you think the growth rate will be from this year to next year? Or actually, I'm not even a big fan of the 2018, right? Because that's just kind of ridiculous. Right? It's going to go up 56%. So I'll probably do something less. Maybe I'll use the 25, right? 25, something a little bit more realistic. So if I do that, so what's 9.12 times 1.25? What does that give me?
11.4.
11.4 estimate. Got it. And then what do we think the growth rate's going to be between this year and next year? Can it do enough? Is it going to be higher, same, or lower? You tell me.
Lower.
Probably going to be a little bit lower. Do you think it's still going to be, are we going into a recession in the next 12 to 24 months? So is it going to be negative? No, it's probably still going to grow. And as interest rates go up, actually their net interest margin goes up too. Okay, so they still remain their positive cash flow growth rate. The problem is that we found out the other day that Lloyd Blankfein, who was the president of the company, had basically met with the officials in Singapore, particularly the officials that were overseeing their sovereign wealth fund, their pension fund. And what we found out was that those officials that Lloyd had basically met with were actually the ones that stole the billions of dollars from the Singaporean pension fund, from their sovereign fund. So basically Lloyd Blankfein, who was the president of Goldman Sachs, met behind closed doors with basically some criminal politicians that basically built billions of dollars from the Singaporean pension fund, which basically means that they wired fraud and laundered billions of dollars through Goldman Sachs using basically the pension fund and the sovereign fund's money. So what is that going to do to Goldman Sachs? Yeah, they're probably going to get an EPS charge off at some point once they file a lawsuit against them, but it's not going to happen right now. It probably won't happen for a couple of years. And lawsuits like that don't happen all the time, so it's probably going to be an isolated event. So we have to just take that into consideration. It's unfortunate. So what growth rate do you want to use to get the 2019 earnings per share? What's kind of your range?
7.
7%? Are you sure you want to go right to 7 that quickly? Maybe we do 15. So it's 11.4 times 1.15. So it's 11.4 times
13.
1.15. What is it?
13.1.
13 what?
Point 1.
Okay, 13. You might want to follow along with this stuff because you're going to have to like go do this over the next 2 weeks and then come back. I'm going to give you next Tuesday to go do this stuff, work in a group, and if you want to send me a PowerPoint presentation for me to review your assumptions, I'll do it for you and see how you're doing. And then you're going to come back the following Tuesday and you're going to present. Right? Isn't that what the schedule said? Yeah. Okay. So you may want to follow along. So what growth rate do you want to use between 2019 and 2020? You want to go right to the 7? Okay. 1.07. So it's 13.10 times 1.07. Usually what I'd like to do is to get some kind of consensus, but I'm only getting a few people that are participating, so I'm just going to go ahead and take their recommendations. Unless somebody else has any recommendations, I'll take your recommendations. I usually like to work on a consensus basis. Because if one person does all the thinking, then you guys are all subjected to groupthink, and you're basically putting your hands into your decisions in somebody else's hands. Maybe you feel comfortable doing that, but if the model blows up or they make a bad decision and he gets laid off or she gets laid off, you're probably going to get laid off too, because you let them get away with it. So what's 13.10 times 1.07?
14.
What is it?
14.02.
14.02. Am I just too hard on you guys? What's the growth rate between 2020 and 2021?
11.
What's the probability of a recession in the first 5 years of every decade? Have we had a recession in the first 5 years of every decade? Yeah. Yep. And what's the first 5 years of the decade? When does it start? In here. You're not going to use negatives on the EPS growth rates, but you're probably going to take them down in anticipation of some type of recession. Okay? You don't go negative on these things. Midstream within the pro forma. Okay? But you need to be cognizant that things will probably significantly slow down as we go further out. But Goldman Sachs can manage the earnings per share and the earnings per share growth rates. As you know, as an accountant, you'll find out that we do smooth out the earnings per share. And we can manipulate them fairly well. So what growth rate do you want to use between 20 and 21?
6.
1.06. So what's 14.02 times 1.06?
14.86.
What do you want to use for the growth rate between 21 and 22?
5.
1.05. So what's 14.86 times 1.05?
15.61.
And what do you want to use between 2022 and 2023? I have 42 analysts in this room.
4.
And I got one person that's giving me consensus.
Let's do 4.
1.04. So what's 15.61 times 1.04?
16.24.
And what do you think the growth rate's gonna be between 23 and 25?
Negative.
What is it? No, you don't wanna use negative.
No, negative.
2%.
1.02, so what's 16.24 times 1.02?
16.56.
Do we have all the data that we need to do the valuation? So will you do me a favor? I'm gonna go back there, and we're gonna go do some more work back there, okay? If you need to get up and go to the bathroom, I'll let you get up and go to the bathroom, and I'm not gonna give you a break, because last time I gave you a break, half the course. Okay, so what was the step one, which you wanna do is you wanna come up with the average rate of return on the S&P 500 for the last 10 to 20 years. So what was the average rate of return on the S&P 500 for the last 10 to 20 years? Okay, if you know what it isn't, then you're going to come up with a pretty good guesstimate. So did the S&P 500 return 20% per year over the last 15 to 20 years? No, of course not. What about 3%? The average yield on the 10-year Treasury in 30 years is 3%. The average yield on the 10 and the 30-year Treasury over the last 15 years has been around 5%, 5 to 7.
It's probably like 10.
Yeah, it's probably like 10. Can you give me a range?
8 to 10.
Yeah, exactly, 8 to 10. 8 to 10%. Excellent. Oh, we're good. What's the beta for Goldman Sachs? What's the beta? And if I was to calculate the expected return on Goldman Sachs or the cost of the equity, what model would I use? This is the oral exam. I'm testing you to see how much comprehension you have from the basic fundamentals in corporate finance. So what's the beta?
1.08.
Got it. And then what model do we use to calculate the expected return and the cost of the equity? Calculated it like 3 or 4 times on the exam, you know, in the book, and we presented it. So what model do I use to calculate the expected return on the equity and or the cost of the equity? Now that's the valuation model. What model do we use to come up with the expected return on the equity? Can you like jump on your computer and Google and say calculation of expected equity return or calculation of the cost of the equity?
We use CAPA.
Got it, capital asset pricing model. Nice job. So we're going to use the capital asset pricing model. Okay. This is just a test to see if you guys can follow me along. So what is the equation for the capital asset pricing model? Click, 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 go on computers, what is CapDev, bing, 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 bing. All of a sudden, wow, the internet is phenomenal. It gives you the answers instantaneously. But when I was your age going through it, we didn't have computers, okay, or cell phones, or tablets, or Twitter, or Facebook, or any of that stuff. So what's the equation for the capital asset pricing model? What's the equation for the capital asset pricing model?
Dividend per share divided by.
No.
Risk-free
Try
rate.
again.
Expected return of
What is it?
investment.
What is it?
Return of investment.
Got it, that's the expected return on the equity, got that.
Equals the risk-free rate
Got it, risk-free rate,
plus beta of the
Got it.
investment.
got it.
Multiply.
Multiplied by expected return of market.
Times the
Minus
expected
the-
return on the market,
minus
Risk-free rate.
risk-free
got it, excellent. Do we know what the risk-free rate is? What risk-free rate do we want to use? What do we want to use for the risk-free rate? What bonds are risk-free? What bonds have zero default risk? What bonds are the largest bond market in the world? What is it?
Treasury
You
bonds.
got it, okay. So what maturity do we want to use? What maturity do do we want to use as a proxy for the risk-free rate? Do we want to use the 3-month, 6-month, 9-month, 1 year, 3 year, 5 year, 7 year, 10 year, 30 year?
10.
10.
10. So what's the 10-year treasury yielding right now? You can get it on Yahoo Finance too. Where's the 10-year treasury yielding?
3.15%.
3.15? Got it. So that's the 10. Where's the 30 right now? Because that's the one's going to give us a little bit more inflation risk premium. Where's your computer? Not working? Or do you have a look at it? Well, what about this one? Oh, well, somebody share the computers with me. There's one up there. Where's the 30-year right now?
3.36.
3.3?
6.
3.36. Got it. Do you think that interest rates are going to go up or down over the next year? Unemployment is at what? 50-year lows, 3.7. CPI is running at about 3 or 4%. So we got inflation, we got wages growing at roughly 3 to 4%. Is that inflationary? Yeah. So from using the Fisher equation, do you think that inflation expectations are going to go up or down? Up. If they go up, what direction do interest rates go?
Down.
Really?
Up.
They go up. So if you think interest rates are going to go up, this is where they are today, give me a risk-free rate, forward curve, forward projection on the 10-year or the 30-year. What is it? We're currently at 3.15 and 3.36. We think that interest rates are going to go up next year. What are we going to adjust it to get the risk-free rate so we can solve the problem? We know it's not going to stay the same, and we know it's not going to go down. We know it's going to go up, so why don't we just give it a little something?
3.4.
3.4. 3.4, got it. Okay, wasn't that easy? Got it, okay. And what did you say the average return on the market was? What did you say the average return on the market was? 8 to 10, so what do you want to use? 9. 9%, got it. So it's 9% minus 3.4, which will give us the market risk premium. You're going to have to start doing the calculations. I can't do all this stuff.
5.6.
5.6. Got it. And then what was our beta?
1.08.
1.08. So what's 5.6 times 1.08?
6.6. It's just 6.
6.6?
No, 6.0. It's just 6.
0?
Yeah.
What is 6.0 plus 3.4?
9.4.
9 what?
4.
That's Goldman Sachs expected equity return, and it's expected cost of equity. This is how you use the stuff you learned in this class. Okay. And if anybody does go on to be interviewed with a CFO or in any investment firm or anything like that, they're going to ask you about countdown. Okay. And if you don't know it, find somebody else. Okay. What about the yield to maturity on Goldman Sachs bonds, with maturities between 7 and 10 years? Because I want to come up with a cost of debt. I know the cost of equity, and I know the cost of debt, and I know the capital structure. I can calculate the weighted average cost of capital, which gives me another discount rate. And the cost of the equity is another discount rate. And the expected return on the market is a discount rate too. So between the three methodologies, we can come up with the sensitivity and discount rates. And then we can start plowing out the valuations. But the first step is you got to calculate the discount rates. Okay? So can you find me on Mergent or on Goldman Sachs in their 10K or 8K or press release on their website under Investor Relations? Maybe you can Google Goldman Sachs yield to maturity on 7-year bonds. Can you do that? Can you plug that in? Yield to maturity on Goldman Sachs 7 to 10-year bonds. Bam, Google. Go up to the 10K, go to the press release. Go to the annual report. You might dig around, you might be able to find some financial information. Does anybody think that they're gonna go work for some publicly traded companies when they leave here? Are you gonna go work for companies that are publicly traded? Anybody gonna go work for any publicly traded companies? Do you know what they give you when you go work at publicly traded companies?
Stock options.
They give you stock options and stock grants. So why would you go work for there so that you can get rich, getting the stock grants and the stock options? Before you go into the interview, you gotta be able to do all the research and find everything about the firm. This is how you dig around and find the data. Anybody find any yield and maturities on 7 or 10-year Goldman Sachs bonds? Are you finding anything? Are you Googling? Are you anything?
For 2018?
It doesn't matter.
Okay.
It's just gonna give me a proxy cost of debt. I just need some kind of sampling. And if you don't know it, can we figure it out? Yeah. What's the current treasury yield? What's the current treasury yield? What's the current 10-year treasury? We just
It's
3.1.
3.15.
3.15. Do you think Goldman Sachs can issue bonds at 3.15?
Yes.
Okay,
Yeah.
so Goldman Sachs is basically a sovereign country, and Goldman Sachs has its own central bank in which it can print its own money to pay the coupon interest rates and the principal of the loan. Is that what you're saying?
Yes.
Yeah, okay. So Goldman Sachs is a central bank that competes with the Federal Reserve Bank. That's what you're telling me.
Oh, no.
No, it's not. Okay. And it's not the federal government, U.S. government. So Goldman Sachs bonds cannot yield the 10-year treasury because the 10-year treasury is the risk-free rate. The average yield on the 10-year treasury over the last 30 years in the growth peak phase of the business cycle has been between 5 and 7%.
So I believe Goldman Sachs is at 4.7 then.
4.7?
Yeah.
So roughly 5%? So roughly 5%?
Yeah.
On what maturity?
I'll look back to you.
Okay, that's okay, that's pretty good. So did you say 5.7?
4.7.
4.7, so roughly 5%?
Yeah.
Do you think interest rates are gonna go up or down next year? I already asked you the question.
Down.
It's gonna go up.
Up.
So obviously at 5%, 4.7, 5%, do you think that their borrowing costs are gonna go up or down? Up, okay, so are they gonna be able to borrow at 4.7 next year if interest rates are going up?
No.
No? So what do you think their borrowing costs are gonna be next year, if they're currently at roughly 5%? 6%, 7%, 7%? Maybe we should be conservative and just say 7%.
Oh.
You know what it isn't, you know what it is. It's called deductive reasoning. If you go out into the marketplace and you look at the data and you find a bunch of data points, that's gonna be deductive. That's gonna be inductive reasoning in which you're using to build your case. Deductive reasoning is figuring out what it can't be and what it isn't, and then you basically narrow it in and you come up with a point estimate. I bet we're super, super close, okay? So we got the cost of the debt, we got the cost of the equity. Oh, we gotta now calculate the weights of their capital structure to be able to get the weighted average cost of capital. Then we can start doing the valuations. So it's 18 billion plus 82 billion. What is it? 300 what? 312?
300 billion.
300 billion? Can I calculate the weights now of how they're financing their long-term assets? Yes. So it's 218 divided by 300.
72.6.
So it's roughly 70, 30. Got it. Now can we plug the numbers in to calculate the weighted average cost of capital?
Yes.
Do we have all the data points? Calculate the WACC.
Yeah.
See, what happens is what you do is you learn this stuff from your books, and you calculate all this stuff in your homeworks and stuff, but you never know how to pull it together and integrate it into an actual methodology or a solution. You learn things discretely by chapters and stuff like that. You gotta kind of pull it all together to show where the value is. All right, So we know that the weight of the debt is 70%, and we know that the cost of the debt is 7%. So what's 0.7 times 7?
Point something. 0.49.
0.49? Or 4.9? 0.9, got it. And then do we know what the weight of the equity is? Yes. Do we know what the cost of the equity is? Do you want to use 9.5? Just use 9.5 just around it. So it's 0.3 times 9.5.
2.85.
2.9.
Yeah.
Okay, so it's 2.9 plus 4.9.
7.8.
What is it? 7.8. Got it. Okay. Look at this. I think this is the way we're going to do it. So right here, basically our estimated cost of the equity, let me just use 9%. The estimated WACC is 8%. Actually, let's take the, let's do it this way. Let's take the 8% from the expected return on the market. Expected return on the market of 8%. And then let's round this down to 7%. We got the discount rates. Doesn't need to be totally scientific, you just come up with a range. You use 100 basis points or 1 percentage point differential in the range for the sensitivities. It'll make the mathematics so much easier when we come over here. So that whole exercise right there was to come up with the discount rate sensitivities. So now we can apply them to the valuation. All right. So can you read off for me what our WACC was? What are we using? 7%?
Yep.
And what are we using for the expected return on the market? 9%. What are we using for cap now? Is that right? I don't think that's right. 8%. 8. 9. Do we have the sensitivities now? Can we plug them into the, do we have the 2019 earnings per share? Yes, no, yes, no. Do we have the 2019 earnings per share? Yep, and we have the discount rates. So can we start calculating the valuations? Can I start calculating the valuations? Yep. So let's do it. So what is the earnings per share for 2019? What's the earnings per share for 2019? See, what will happen is a lot of people won't be able to follow along, and then what they'll do is they'll take Wells Fargo and Bank of America numbers from the book and they'll put it in as Goldman Sachs. I've seen that like multiple times over the years, okay? Because you're not following along. I don't mean to be hard on you, but I've seen it over here. I've taught this class for 6 years. I've seen everything. So what's the 2019 earnings per share? What's the 2019 earnings per share? What is it?
$13.
$13.10. Got it. Okay. And then, what is the, actually what I want to do is I want to use the WACC, the expected return, and then the CAPM. I want to go in that order. I'm going to change this around. So this is the WACC. And this is the capital asset pricing model. Got it. So if I want to calculate the intrinsic value using the WACC, I'm going to take the 1310 and I'm going to divide it by 0.07. So give me the valuation, please. Don't worry, when you get into the real world, it's going to be harder. Okay. So what is 13.10 divided by 0.07?
187.
I get
.14.
1.14, got it. And then, where's the current stock price today? 205, is that pretty close?
Yeah.
Yeah, it's pretty close. What is the 1310 divided by 0.08?
163.75.
163.75, got it. What's 1310 divided by 0.09?
145.55.
145.55. What does perpetuity assume about the cash flows into the future? They remain flat. They remain flat. Is that a good assumption?
No.
Because these guys are over 100 years old and with almost $1 trillion in assets. They're a money machine. Okay? And they have political power in Washington to make sure that their earnings grow at a constant rate forever. Okay, so over here we're going to do the Gordon growth model. So we got the discount rate. So read off the discount rates again.
7%, 8%, 9%.
Got it. And then what I do is I went ahead and did the growth rate scenarios. Do you think that Goldman Sachs can grow its earnings at 2 and 3% forever into the future?
Yeah.
On $1 trillion firm asset base? You do?
No.
It's $1 trillion company. Do large, really big companies grow their earnings per share at a very rapid rate, or is it smaller firms that do that?
Smaller,
firms.
yeah.
So is Goldman Sachs a small firm or a big firm?
Big firm.
Massive.
Big firm. Do you think they're going to be able to grow their earnings at a very rapid rate into the future? Probably not. So what growth rate scenario should we use? Probably use 1. Okay. Well, we'll go ahead and do the calculation because I want to show you the methodology. All right. So what's 7 minus 1? 6. So what's 1310 divided by 0.06?
218.33.
218.33. Okay. So you need to watch this. Okay. This is extremely important. Okay. You need to pay attention. What's 8 minus 2?
6.
What's 9 minus 3? 6. So can I just use the diagonal?
Yeah.
Yep. So 218.33. 218.33. Got it. What about 8 minus 1? Is what? 7. Did we already do that?
Yeah, it's 187.14.
Got it. 187.14. Can we do the diagonal?
Yeah.
Yep. 187.14. Got it. What's 9 minus 1?
8. It's
What was 8?
163.75.
Now we're starting to leverage a lot of the methodologies and a lot of the data. It's a little bit easier than you think. What's 2 minus 8? 6. Do we have a 6? Do we have a 6 scenario? Do we have a 6% scenario?
No.
Now we got to calculate it. So it's 1310 divided by 0.06.
Did you mean 7 minus 2?
Yeah, 7 minus 2.
So
0.05,
5%.
thank you. So what's 1310 divided by 0.05? Thank you very much for that, I appreciate it.
262.
So 262.00.
Mm-hmm.
Okay. Can I fill in the diagonal?
Yeah.
262.00, got it. What about 7 minus 3?
4.
4, what's 1310 divided by 0.04?
327.
What is it?
327.5.
You're going to want to take pictures of this because basically you're going to be putting these into the presentations here. Okay. We're basically doing the valuation work right now. Okay. Unless you guys want to do it yourself.
No.
Okay.
Thank you, though.
You're welcome. I thought it would be easier if we all work together. Okay? Don't take pictures of this yet. Because we haven't solved it yet. 7%, 6%, 5%, 4%, 2%. let's do the multiple approach.
Yeah, can you send it?
Let's do the multiple approach. Is that okay? You might want to move the camera over here. Okay, now the multiple approach. Can somebody give me an estimated 2019? What do we think the stock price is going to be next year for Goldman?
Like 615.
Like, no. What is it? What do you just give me a guesstimate of what you think the stock price will be?
210.
Like 210. Okay, so what's 210 divided by 1310? Or give me an estimated PE for 19.
16.
That seems a little too high.
Like 50.8.
Yeah, I don't know. Let's just say 14 for now. Okay, just for now, just so we can plug some numbers in there. All right. Can I take 1 and divide it by the discount rates and get a multiple? Can I take 1 divided by the expected returns and get the multiple? Can I take 1 divided? This stuff's like this. I get this stuff all the time. Okay, I get calls from people all the time doing this stuff. This stuff is stuff I work on all the time. Can I get a multiple by taking 1 divided by the expected return and discount rates? Remember on the midterm, when it only gave us the expected return? Didn't we calculate a multiple by doing the 1 divided by the expected return?
Yes.
So what's 1 divided by 0.07? It's 1 divided by 0.07, which is the WAC calculation. Can you run the
14.2.
calculations for me? I'm just concerned you guys are lost back there. What?
14.28.
14.3, got it. So what's 1 divided by 0.08? What's 1 divided by 0.08? 12.5? What's 1 divided by 0.09?
11.
Can I manufacture multiples by doing that?
Yeah.
Yeah, absolutely. But what's the assumption about the cash flows when you use this method to get the multiples? What are you assuming about the cash flows?
Growing.
Are they growing at a constant rate or remaining flat?
Flat.
Flat. So we should probably use the Gordon growth. So can I do 1 divided by I minus G? And what was our assumption on the growth rate? Using Gordon growth, what do we assume that earnings per share was going to grow at?
Constantly.
At constant at what percent?
What do we say?
At what? What do we decide? What do we use in the Gordon growth for the growth rate, constant growth rate in the cash flows, the EPS? What do we use? What did we use for the
1%.
growth rate for the Gordon growth?
1%.
1%. Great. What's 1 minus 6? I mean 1 minus 7. 6.
6.
So it's 1 divided by 0.06.
16.
What is it?
16.7.
16.7. Okay. And then 1 minus 8 is
7.
what? 7. It's 1 divided by 0.07.
14.3.
Got it. 14.3. And what's 1 minus 9?
8.
8, which is 1 divided by 0.08 is?
12.5.
Got it. Are these ranges of multiples in the same ranges of the multiples up here? Is this a way to check to see if the multiples are correct between the two? Theoretical multiples and the comparative multiples using the peer group? Yes?
Yes.
No? Yep. So what I like to do is do a high to low. So what's the highest multiple? And what's the lowest multiple? And I want to calculate a median. 16.7. Let's just say 16. What's the lowest?
11.2.
No. Of all of them.
80.9.
Basically 8. Oh, I forgot to do these two. What was the 2017 stock price divided by the earnings per share? For 2017 to 9.12. What did we say the stock price was in 2017 on average?
240.
240. And what was the EPS for 17? 9.12. So what's 240 divided by 9.12?
100.
What?
No,
Yeah, 240 divided by 9.12.
26.
26. Do you think Goldman Sachs is ever going to see a 26 multiple again? Probably not. That could be an anomaly. And what about 2019? What do you think the stock price is going to be next year?
211.
211. And then don't we have a 2019 EPS? 1310. What is it? 13.1. So what's 211 divided by 13.1? 16 what?
0.1.
So this one's an outlier, right? 16, 9, basically 8. Where'd you get the 8?
At the bottom.
Where?
City.
No, that's 8.9.
yeah.
Yeah.
It's really 9.
I don't think you put the other one on because the 16 is 16.7 as well.
Yeah, it's too high. I didn't want to go that high. So give me some midpoints. Fill this in. 16, 15, 14, 13, 12, something like that. Maybe 10. Is Goldman Sachs comparable to Citigroup?
They're way big.
Yeah,
they're-
Citigroup is bigger, but Citigroup is a basket case. It's in trouble, okay? It's got major problems, okay? So Goldman Sachs does not have major problems, so you wouldn't use the same multiple. All right, so we have basically the range of multiples. So what are we gonna use? I usually start with a midpoint, median, okay, somewhere in between. So if we use just a median, 14, kind of where the range was, right? Do you think that Goldman Sachs multiple will go to 15 next year?
No.
Probably not. Could it drop to 13?
Yeah.
Yeah.
Could it drop to 12?
Yeah.
14, 13, 12? 14, 13, 12. Do we know what the earnings per share is for 2019?
Yes,
Yes.
What is it?
13.10.
1310? What's 1310 times 14?
183.4.
183 point what?
4.
What's 1310 times 13?
170.30.
What is it?
170.30.
What's 1310 times 12?
157.2.
Are we done with the multiple approach? Okay. Now can we do the discounted cash flow? Okay. So what was the first year cash flow that we're using? 1310. It's year 2. We already calculated.
14.02.
So 14.02, what's year 3?
14.86.
14.86, what's year 4?
15.61.
15.61, what's year 5?
16.24.
16.24, test question. Do I need to calculate, do I have to do a 6-year?
Yes.
Yep, so what do we use a 6-year for? Terminal value, excellent. Hopefully by now, I am just making you sick of hearing all of this stuff, because you've heard it over and over again. Okay? That means I'm doing my job, okay? Because when you're getting this stuff and you're getting tired of it and sick of it, that means you get it, okay? If you're still struggling with that, really, you're gonna need to really fight to understand it at this point, okay? All right, so let's calculate the terminal value. What do we need? How do we calculate the terminal value? And are we going to assume that the cash flows are going to grow at a constant rate or remain flat forever? What?
Constant.
A constant rate. What growth rate do you want to use?
According to
Yeah, so what is it? What's the growth rate that we were assuming that the cash flows would grow at? Constant rate forever?
1.
1%? 1. What's our discount rate that we want to use? 7, 8, or 9?
8.
Okay, I got 1, 7, I got 2 8s, I got 3 8s, I got 3 8s, 3 7s,
8.
8.
8, okay, excellent. So do we want to use 8% or do we want to use 9%?
8.
8 or 9 on the
9.
terminal?
Terminal 9.
Terminal?
9. 9, and what do we want to use for the going in?
8.
And why do we use a higher discount rate?
More risk.
No risk, exactly. Excellent, nice job. So what's 1658 divided by 0.08? 1656.
207.
What is it?
207.
207.
270?
207.
207. 0,
Yeah.
got it. And then what do I do with the terminal value?
You add it to your 5.
Last year, got it. Okay. So it's 207 plus 1624.
223.24.
223.24.
Yes.
Got it. Let's do the discount rates. What's 108 to the 1?
108.
What's 108 squared?
1.16.
What's 108 to the cubed?
1.25.
What's 108 to the fourth?
1.36.
And what's 108 to the fifth?
1.46.
Got it. Whew. So what's that 223.24 divided by 1.46?
152.90.
152.90. Got it. What's 1561 divided by 1.36? Can you guys do the calculations for me? I see people just checking out in the back there, doing other stuff. What's 1561
11.47.
divided by 1.36?
11.48.
11.48. I don't mean to harp on you, but this stuff's just too important. I've only spent like 10 years of my life developing this methodology. What's 1486 divided by 1.25?
11.88.
What is it?
11.88.
Thank you. What's 14.02 divided by 1.16?
11.
It's 12.08.
Okay. What's 13.1 divided by 1.08?
12.12.
12 point what?
12.1.
Sorry. I got 12.12 as well.
Got it.
12.1.
I'll take the 12.12. So, can you add those up and give me the present value of the discounted cash flows using the DCF method? The intrinsic value using DCF. Oh man, how do we do it on time? We might get out of here in like 20, 30 minutes.
I got 200.
You got 200?
Yeah,
Yeah.
0.4.
4.8.
200.48? Got
Yes.
it, okay. Wow, that's a lot of work. Okay, so the DCF, we got 248. What do we get for the multiple approach? What do you want to use?
170.
What do you use, 170?
183. Something in between there, maybe.
I'd say 170.
Because we can't, I don't think, you know, I don't know, what, I mean, do we use 15, 14, 13, or do we use 14, 13, 12? Can we justify the, using 14 for Goldman?
Yeah.
Yeah,
it-
I
Yeah.
would say 14. Yeah,
So
14,
let's
13, 12.
recalculate. Because I usually like to get them in the middle, the ones that, you know, that
Mhm.
target multiples. I like to do them in the middle. So this is what, 15, 14, 13?
So
So your best case, most likely case, and your, not your worst case, but least case. So what's 15 times 13, 10?
196.5.
196.5, and what's 14 times 13, 10?
183.4.
183.4, and what's 13, 10 times 13?
170.3.
70.3, and you want to use the midpoint?
Yeah.
Okay. And then what do we got for, Gordon Grove? What did we decide?
1%.
Yeah, are you gonna use 7, 8, or 9? 8? 8
Yeah.
at 1? And then what do we get for perpetuity? Like 163.75, something like that. Alright. So now we got the valuations. So now we gotta do the scenario analyses to come up with the intrinsic value. And right off the bat,
Gotta
I'm
consult
not sure, right off the bat, I'm not sure we're gonna be buying Goldman Sachs, right? Because none of them are even close to the current stock price of 205, right? So this might be a sell recommendation. All right, so let's do the scenario. What's the scenarios that you want to use to calculate the intrinsic values? So what's the scenarios you want to use? Remember we went over this on the midterm?
Oh.
We did this.
5,
So we do 5%,
yeah. 10%,
we'll do that, 5%, 10%, 25,
60.
60, give me another scenario. Now we're just kind of simulating the different scenarios.
10,
So you want to do 10,
10,
10,
30,
30,
50,
50. Okay, give me another.
10,
10. You guys like perpetuity, don't you?
15,
15.
30,
cool.
You can see the love in the multiple.
45.
45. Okay. Got it. So what were the values again? 163.75. What was Gordon Growth? 187.14. What was multiple? 183.40. What was DCF? 248. Got it. Okay. So 187.14 times 0.1 is what? 18,714. What's 183.4 times 0.25? Can you guys help me with this mathematics, please? 183.4 times 0.27.
45.9.
45 point, is that correct?
Why by 2?
Yeah, wait, what for 2.27?
Why not 25?
Yeah, it should be 183.4 times 0.25.
Yeah.
Yeah.
What do you,
Yeah, it's 45.9, that's correct.
got it, thank you. 200.48 times 0.6.
120.28.
And then, I forgot this one, 163.75 times 0.05.
One 163 point. Oh no no no.
163.75 times 0.05.
Okay, I'm getting 8.18.
8.1.
That's so low.
Is that what you guys got?
Yeah.
Yeah.
Okay, so what's 8.18 plus 18.71 plus 45.9 plus 120.28? Can you do the calculations for me? Can you try to stay engaged, please? I know you all want A's from me at the end of the semester. This is how you get to the A's.
193.07.
193.07, got it. Okay, so what's 163.75 times 0.1? 16.375. This one is what, 18.714, got it. So what's 183.4 times 0.3?
5.
Okay, can you,
55.02.
got it. And what's 248 times 0.5?
100.24.
What is it?
100.24.
100.24. So what's 100.24 plus 55.72 plus 18.714 plus 16.375?
I got 191.07.
191 point what?
07.
07, got it. And what is 163.75, no, that's the same, 16.375. It's 187.14 times 0.15.
28.07.
What is it?
28.07.
If you guys take my investments class, if I teach it next semester, all this stuff is already in Excel software. It would be too easy. You wouldn't learn the concepts if I gave you the Excel. So what's 183.4 times 0.3? I know it's tedious, but
55.
what is it?
55.2.
And then what's 248 times 0.45? 248 times 0.45.
90.2.
90.2. Is everybody checking
Yeah.
those
Yeah.
numbers? Okay, okay.
Yep.
And then what's 90.2 plus 55.2 plus 28.07 plus 16.375?
I got 189.84.
189 point what?
84.
The 55, it's not 55.2, it's 55.02.
My dyslexia is really hit. After I drink like 5 cups of coffee, my brain starts dyslexic accountant, dyslexic finance person. That's horrible. I could lose a lot of people money doing that.
189.66.
189.66. What scenario do you want to use?
192.
191.
1, 2, or 3?
Two.
How many people want 1? How many people want scenario 4? Damn, I tried to get you. How many people want scenario 2? Okay, scenario 3? Okay, 2 has it. Got it. So what's the intrinsic value? What's the intrinsic value that we came up with?
191.07.
193.07.
What?
Yep.
No, 191.07.
Yep, got it. 191.07, got it. Is it greater than or less than the current price?
Less than
And what's the current stock price?
205.
205. What's the premium and the discount, i.e. the discount? What's the discount? What are we forecasting the stock price to fall by over the next year? What is it?
0.01%.
Is it 0.01 or 1%?
Yeah, 1%.
1%, is that correct? Are you guys getting there? Are you doing the calculation?
I got 7.
Yeah, indeed.
Can you calculate the percentage drop? It's 105, 101, 191.07 minus 205 divided by 205, what do you get?
Negative.
7.2? 7.2, discount.
Is that what you have? 7.2? Nah.
What's our recommendation?
Sell.
7.3.
Do you think Goldman Sachs makes up a significant portion of the financial services stock indexes, stock price indexes? So what would be our index trades based on this research? Because Goldman Sachs makes up a significant portion of the market cap of these financial services indexes. So what would be our trades? Okay, and this should be the sing-along
Right forward.
portion of the
Right forward.
of the class, because we went over it on the exam, and you've been doing it on your memos the whole class.
Right forward.
So you're gonna write forwards,
Right futures.
you're gonna write futures,
Right calls on futures.
you're gonna write calls on the futures,
Buy puts on futures.
buy puts
Puts.
on the futures.
Sell short.
And how many trades of the
4.
indexes? 4. Okay. What are our trade recommendations to our clients in a proprietary trading unit for the exchange traded funds. Do you think Goldman Sachs makes up a significant portion of the market cap of the financial services exchange traded funds?
Yeah.
Yes. So what would be the trade recommendations that you would make?
Sell.
Sell. What else?
Buy puts.
Nope.
Sell short.
Sell.
What?
Sell short.
Sell short. What else?
Right calls.
Right calls.
Buy.
Buy puts. How many trades?
4.
You know where I'm
Four. What about the stock? What's the trade recommendations for Goldman Sachs?
Sell.
Sell.
Sell. We're gonna sell short.
Calls.
We're gonna write calls. We're gonna buy puts. How many trades for the stock?
4.
4. How many total trades?
12.
Isn't that fun?
Yeah.
My drawing company.
Yeah. Yep. Great.
25.
I don't think I can do anymore. I'm freaking exhausted. Nice job, you guys.
Thank you.
Thank you.
Do you want these or?
Okay, so let's go through those real quick. Don't leave. You don't know what you're doing. That was just the methodology. Let's walk through this. You need to take notes on these. You need to take notes.
Which one's the best one?
I'll go over it. Let me. If you want me, I can take a look at the ones that you're looking at. I would pass them around and take pictures of them, okay? And then I'll show you what the best ones should look like, and then you bring me the draft. Actually, what I would do is, since we don't have a class next Tuesday, why wouldn't I have a class next Tuesday?
Because we're working in our groups.
Well, why wouldn't I have a class on Tuesday? Even though there's supposed to be a class on Tuesday. Test question. Why wouldn't I have a class on Tuesday?
So we can work on that.
Because most people don't show up. Okay? I've been teaching her 5 years, they don't show up.
Oh, because of Thanksgiving.
Yeah, they don't show up.
Damn. I might extend my flight.
So you should work in your groups, work on the projects, and then send me, okay? Work in your groups, work on the projects, send me your PowerPoint, and I will give you some feedback. You give me your phone number so I can call you back, and we can go over it over the phone. Alright, so hold on, let me go through this. Okay, do you guys know what this is? Do you know what this is?
Stock valuation.
Okay, this is called a deck. This is called a pitch book. Okay, this is what we use in the business book. When you leave this class, if you do a really good job in this class, you will walk away with 5 memos and a pitch book. How many classes do you take where you walk away with marketing product?
0.
Exactly. Okay. So this is it, you need to listen. Okay? There's very specific instructions for this. Okay? And I get over the years, I get all kinds of weird stuff from people. And if you follow the instructions, it'll make it easier and you'll be able to use this. Okay? All right? All right. First things first. When you go to print this, when you go to Kinko's or FedEx or wherever you go to reproduce this, this is the final version. This is the way it looks like. This is what it should look like the night of the final, when you deliver the final product. Do not produce this prior to the final night, because I will be editing it, and I've had a bunch of students over the years will produce this final thing and I'll rip it apart, okay? Because it's not ready to go to production yet. But this is how your production unit should look like. Not next Tuesday, but the Tuesday after next. You're going to come in and you're going to do a dry run presentation, okay, your group. The presentations, the worst presentations are 10 minutes, okay? The best presentations are 5 minutes. And the good ones are around between 5 and 8 minutes, maybe 6, 7. you go to 10 minutes, you're reading from the slides, you didn't study the slides, you don't know what you're talking about, okay? You do 5-minute pitch, in 5 minutes, bam, you are on fire, you're blowing through the slides, you're walking us through it, you're selling us the recommendation, okay? So that's kind of what I've seen, and that's the standard, that's standard business. So here we go. This is a clear cover, okay? Anybody have a opaque cover?
No.
On theirs, anybody have an opaque cover? No, because I threw them away, okay? Because the first thing they see is this cover page, and if you have an opaque cover, you're blocking the ability of the reader to read the most important page of the whole document, the front page, which is going to provide them with the first impression. You put an opaque on this thing, they're going to think you're hiding something, okay? You put a clear cover on this thing, you're not hiding nothing, okay? You're totally confident in your capabilities to be able to present this thing. Bam, done. On your cover page, we know who the company is that we're evaluating, okay? Now, here's part of the problem in the presentations over the years that I've noticed. When students do the presentations, they talk about the analysis as though they work for the company. You do not work for Goldman Sachs. You are a securities analyst, a portfolio manager, you're a public equity, advisor. You're not, you do not work for Goldman Sachs. You are critical of Goldman Sachs because you want to be accurate in your valuation, to be accurate in your recommendations, to give basically trade recommendations to your clients and your proprietary units to basically make money. So we have no allegiance to Goldman Sachs. We're just doing research to make an investment decision, period, and they just happen to be one of the hundreds of stocks that we cover, okay? Right off the bat, it gives you the recommendation. It gives you the intrinsic value with the price right there, and it gives you the stock price right there. The prices have to be next to each other, and it calculates the premium and the discount. You give me your team members' names right at the bottom, and do not put USF, do not put Business 305, Principal of Finance, do not put anything on here that makes it look like it was produced for a class, okay? When they look at these things, you bring them in the office to the potential employer for an internship or a job, I want them to think that you've done this in your career, okay? Okay? So the first page is important. Then I need to know what the outline is. You gotta walk us through and tell us what the outline is. What are we gonna be doing in the presentation? You gotta give me some basic information, a dashboard on the key metrics for the company, okay? Then the second is, this is pretty good, the bank rankings. We already did the bank rankings over here, but you gotta put them in here. Hold up, if you've got these pages, you should hold them up and show them to me, and I can tell you which ones are good and which ones aren't good. This one's really good.
Does it matter the order?
That one's really good.
Does it matter the order of the page?
It should be JP Morgan first, Goldman Sachs should be last.
Oh no, I mean because this is behind. It's not the second page.
Oh, we can work out the order later, but it should go from macro down to micro. That one's not so good. See how it says institutional name at the top and it's up at the top? That one looks pretty good. That one looks pretty good. That's the introduction page. That one actually looks really good. That's the cover page. That's not the top 10. That one looks really good. That one's off. Those aren't centered correctly in the page, and you see how the titles. So the formatting's off on that. That was perfect. So I'm going to go through these when you bring them to me, and you print them out in black and white and staple them together. And when you come in to do the dry run on the draft presentation, you're going to give me a black and white version, and I'm going to have a Sharpie, or I'm going to have a stack of Sharpies on my desk, and I'm going to just start, yeah, because I'm a managing director. That's what we do. People give us stuff all the time. We basically edit it. They go back, they fix it, they bring it back. We edit it again. They go back, they fix it. They come back, they edit it. I look at it again until it's perfect. Then I say go to the print shop and go print it and go bind it. Okay? Then you might want to have the mission. You could have the mission or the goals, objectives. That's kind of fluffy stuff, but my biggest. Oh, this is a good one. The leadership. This is where everybody messes up. because they basically go copy these things off the website, and look at that dude, he's just all, he looks like Gumby, right? These are really good pictures right here. But that guy, he's all distorted, so if you know how to use Photoshop and basically crop these things and make beautiful pictures out of the pictures, that's gonna go really far. If these things are all messed up, I'm gonna give it back to you and have you redo it. Okay, so hopefully somebody on your team is a marketing director that knows how to do the marketing. Hopefully you have a finance person to basically check the numbers. And then you have a leader of the group to basically drive the production and make sure you get the thing in on time, right? You need the three.
Yeah.
The leaders are extremely important. Could you please not talk? The leaders are extremely important. You need to have their names. You need their title. You need where they did their graduate degree, and most of them went to Ivy League schools. The number of years they were at the bank, and if there was any other banks that they had worked with prior to that. Okay? So right off the bat, I know exactly how long they were with there, if they're a man, if they're a woman, if they're a minority, how long they were with the bank, where they did their MBA. A lot of them went to Harvard or MIT, and then if they worked at any other banks. Okay? And JP Morgan and Goldman Sachs like to steal top talent from the other competing top 5 banks. Okay? So the leadership's really important, and if you do any research on the leadership, it would be really important to understand the leadership style of these leaders, because it basically tells you the corporate culture and how these leaders are portrayed as models that are emulated within the company to create the company culture. Does this all sound familiar? Yeah, this is all your capstone. You guys aren't seniors yet. This is basically a midterm capstone assignment. Major lines of business. What I like to see is not only their major lines of business, but where they generate the majority of their revenue. So that's going to tell me their comparative advantage. Not only what lines of business generate the majority of the revenue, but what products and services generate the majority of the revenue and contribute to the most to revenue growth. Okay, those are the things that I'm looking for. Then you do a SWOT analysis. Okay, SWOT analysis. So I think in Mergent, they do, you can get commercial, bank, industry information. You might be able to get it from S&P, you might be able to poach it from iBiz, you might be able to get it off the internet somewhere and find a report. This is the SWOT analysis that basically lays out the strengths, weaknesses, opportunities, and threats to Goldman Sachs. Okay? And one of the biggest threats, the biggest weaknesses is not only regulation, but litigation, especially after last week. Okay? That's one of the biggest problems. And maybe our projection to actually sell the company's stock is probably a pretty good projection, considering how much trouble they're going to be in. Okay? Because they're going to be in real big trouble. And then the financial conditions. You have 2 pages of financial ratio analysis, okay, broken up into categories. Here, you're going to have Goldman Sachs as your target company. JP Morgan is the direct competitor. The peer group, there's the peer group, there's the methodology on how to calculate the peer group ratios. Do not put another company in there, okay? And then you can use the industry ratios that are provided here in your report, because we really don't care about the industry ratios when we're giving the overall condition based on this row of financial ratios. So for example, I'm going to look at the return on equity, which is the #1 financial ratio that every investor looks at, because that's what I want, is the ROE. So I'm going to look at the ROE, and I'm going to see, is the ROE higher than the direct competitor and the peer group? Is it basically the same as the peer group and the direct competitor, which is still going to be good? Or do they blow them out of the water where it's significantly higher than the direct competitor and the peer group? If it is, I'm going to give it an excellent. Okay? So the methodology around that, because I don't have a lot of space here, is if Goldman Sachs blows away JP Morgan and the peer group, you're going to give it an excellent. If it's basically on par with the peer group, and the peer group's higher than the direct competitor, I'm going to give it a good. because it beat the peer group. And if it's above, if the ratio is above the industry, I give it above average. If it's equal to the industry, I give it average. If it's below the industry, below average, and if it's significantly below the industry, I give it poor. Do not make up your own conditions. If Goldman Sachs is significantly higher than the peer group and the direct competitor, do not put in totally rad, you know, or amazing or awesome or any of that stuff. Use these. Don't use your slang, you know, don't use the slang. Just use these. Boom. And then what you do is once you put the financial ratios in, you basically analyze the financial ratios row by row, give it the conditions, and then step back and go, huh, at 2 excellents and 4 goods, I'm going to give it an excellent. Excellent. And then I'm going to do another set of financial ratios because I want two samples of the ratios. Do the same thing. So you got good, poor, poor, excellent, excellent. I'm still going to give it excellent. Because Goldman Sachs and the other top 5 banks are some of the top banks out of the 2,000 banks in the United States. Okay? They're like the top banks. That's why they have $2 trillion in assets management, because they're amazing. Then you're going to get into the valuations. Your first valuation methodology is technical analysis. Okay? So you're going to go up to stockcharts.com. I'm running out of space. Stockcharts.com. And you're going to go 3 years. You're going to do a 10, 30, and a 50-day moving average. If you have a problem with that, I'll help you. Just get the 3 years of data. And then plot the graph in there. Identify the support lines, resistance lines, breakouts, supports, the resistance, trading ranges, consolidation, sideways patterns, the stuff you did on your exam, on your quiz. Okay? And then what you need to do is you can see that the stock was in an upward trend, right, for the last 3 years. So we're going to assume that this trend is going to continue. So if we take out that trend into this time next year, where would be the stock price this time next year if that slope holds? Okay? Then you're going to take that price that you come up with and plop it right there, and it's going to be the target price. You're going to compare it to the current price, and you're going to calculate the premium or discount. Over here on the side, you got, it looks like here, a downward RSI, downward MACD, sideways trading pattern, higher selling volume, but overall upward momentum. So you put some of the technical stuff in there. Then you got your perpetuity model. Okay? It should look exactly like this. Okay? It should look exactly like this. You got your CAPM right there. You got your earnings per share up here, 2017, 18, 19. You got the earnings per share. You got the growth rates. You got your 7%, 8%, 9%. You got your intrinsic values from high to low. You're going to use that midpoint intrinsic value. You're going to put it right there, and you're going to calculate the discount of the premium. Boom, next. And you got the Gordon growth method, CAPM, earnings per share table, the same one. And you got the, where is it? Gordon growth valuation matrix right down here in the right-hand corner. The formatting of these things are extremely specific because you know how many of these things I have to read on a quarterly basis? Do you know how many of these I have to go through at my office as the managing director of equity research?
100.
Yeah, like at least 100 every quarter. So if there's different formatting, is that going to slow me down?
Yes.
Yeah, I'm going to throw it back at you. Okay, because I don't have time. I can whip through these things in literally like 30 seconds. If the formatting's off, I'm gonna just go like that. Okay, because you're slowing me down. Because time's my enemy. Okay. Here's the multiple approach. Here's the multiple approach. I got the 5 banks. I got the 2000, where is it? I got the 2017 and the estimated 18-19 multiples right here. I got the earnings per share table up here. And I got the intrinsic valuation. I got the multiple approach right here. Here's the multiples from high to low. Here's the valuation, high to low. Pick the midpoint, that goes there. Current stock price, premium to discount. Next page. And actually, if you get a good one, of these, you can scan them. Go online, one of those services, and basically convert these PowerPoints into, these scanned PowerPoints into PowerPoint. Right? That's pretty cool. And then you can start manipulating it. Or you can put them together by scratch. A lot of people like to build these decks to get the experience, because we're all going to be building these decks at some point in time in our future. So you better know how to build a deck. Okay? And then the sensitivity analysis. We got the intrinsic value, methodologies, the valuation models, intrinsic values, we got the scenarios, we got the intrinsic value right there in the middle. It's going to be a hold. That intrinsic value goes there compared to the current stock price, premium discount, calculation. Next page, recommendation, intrinsic value compared to stock price, premium discount. You got your total trades. Next page, you got the references. Even though you guys only have Mergent, unfortunately you only have Mergent with earnings per share going back 5 years, I would replicate these references. Because the more references you have, the more legit your research is going to be. Okay? And then usually what you would have on the very, very last page is you would have your names, and underneath it, it would say Senior Equity Research Analyst, Junior Equity Research Analyst, Portfolio Manager, CFA, Chartered Financial Analyst, CPA, PhD, MBA, whatever acronyms, whatever credentials. And then next to your name, there would be there would be a line that says name, and another one that says date, and you would sign it. Because this would be, since you're a CFA, you have to sign off on this research, because you had to produce this based on the ethical standards basically bestowed upon you as a charter financial analyst through the CFA Institute. So you have to have this. Does anybody not have a black spiral binding? Does anybody not have a black spiral binding like this? Can you show me it?
Oh, no, I don't.
Okay, does anybody not have one on their examples? No, they're all spiral like this? Yeah, because I threw out the other ones that didn't have it, because it didn't meet the standards. And you need a black back. Okay, clear cover, plastic wire binding, black back. Okay? Do not produce the final document like this until the night before the final night. And you can come up to me, and I will hang out, I will be around, okay, during that week to check your work, to get your grades, to review your memos, to review your pitch books, to do anything I can to get you the A in the class, because that's what you want, isn't it?
Yes.
Isn't that everybody? Don't you want an A?
Yes.
Okay.
Yes.
Okay. All right. So I'm going to make you work. Okay.
We don't keep these, do we?
I will let you borrow these. I will let you borrow some of them. Oh, no, wait a minute. Okay, so here's the deal. I will let you borrow them, but here's what happens every single semester. Half of you guys steal them from me. Okay, you keep them.
It's weird.
Okay, so you need to raise your right hand. Raise your right hand. Everybody raise your right hand. Please straighten to high. And repeat after me. Dear Professor Souza.
Dear Professor Souza,
I promise I will not steal your pitch books.
I promise I will not steal your pitch books.
And I will bring them back to you when I'm done.
and I will bring them back to you when I'm done.
Great, thank you very much. Okay, if you need to go over anything, I'm here. If you want to go over any, check your grade or any of that stuff,